Thank you for trying financetrainingcourse.com, an online collection of risk, Basel, treasury, and portfolio management resources created by risk and treasury professionals.
Welcome to our second session on capital adequacy. When we stopped earlier, we reached the milestone of 2003, and we just introduced the concept of the Basel II standard. Now, the Basel II standard had three pillars. Pillar 1, that dealt with minimum capital requirements, or MCR for short. Pillar 2, that dealt with supervisory review, and pillar 3, that dealt with market disclosure. MCR's primary focus was on defining an adequacy standard that banks were expected to follow, and to rate and review banks based on how their existing capital levels fared with respect to the minimum capital requirements. Pillar 2 dealt with an additional set of reports and processes that were required by the regulator to review the performance and the margin of safety uh, established or kept by the bank in question. While Pillar 3 assumed that the bank will share fairly detailed disclosures that the market itself may use to assess how safe a given financial institution was. So the idea was that if you combine Pillar 1, which was minimum capital requirement, with a fairly detailed supervisory review, some would even call a very fairly invasive supervisory review, and then supported by providing sufficiently detailed information for the market to make its own assessment and react to any problems and troubles. The concept was that over a period of time, these three pillars would work together to ensure that the failure of large banks, the failure of even mid-sized banks, would become a much smaller probability. So within Pillar 2, there was an additional component, and this component was called ICAAP. So as part of the supervisory review process, banks were required to create a document that in a very cryptic sense was called internal, that's I, capital, that's C, adequacy, that's A, assessment, that's A, process. And the rationale and thinking behind ICAAP was that rather than limiting yourself to the risks covered in Pillar 1, which were market risk, credit risk, and op risk, banks should also look at additional sources, additional risk factors that should require them to put aside more capital. And what did this list of risks include? The first and foremost was interest rate risk. The fact that banks go out and create gap to capture the interest rate spread across different maturities. Second was liquidity risk, the fact that banks may not be able to roll over their liabilities and deposits as planned or as expected. The third was making strategic bets that go wrong and that actually lead to operational losses that lead to more additional trouble. The fourth was legal and reputational risk, and the fifth was anything else that would fall in the other category. Rather than looking at this as a purely regulatory exercise, the regulators also expect banks to do this as an internal process. So, look, when you do MCR, as a document that is prepared primarily for the benefit and consumption of the regulator. So if I take this piece, this is the piece that falls under MCR and is primarily prepared and produced so that the regulator can simply rank and assess banks based on their requirements, based on their adequacy requirements. and take any action, um, since MCR would be the primary signal. But at the same time, banks were expected to use the internal capital adequacy assessment process to take a look at their other risks and then share that information at a sufficient level of detail with sufficient frequency with both the senior management team and the board of directors, so that they were completely aware of the exposure that the bank carried across each of these risk categories. And rather than limiting themselves to just a regulatory point of view, do it from both a regulatory capital as well as an internal capital process, as well as from an internal capital point of view. So, so while in 2003 the Basel III standard came out, um, Pillar 2 requirements were the prime, Pillar 1 requirements were the primary push. By the time you got to 2005, 2006, Pillar 2 requirements were being implemented across the board, and then there was Pillar 3 implementation, which was market disclosure. Now, some of this changed after the financial crisis hit. So, when you finally got to 2008 and we were hit first by the failure of Bear Stearns, then by the failure of Lehman, there was an increasing, I wouldn't say, I think the appropriate way is there was dissatisfaction to some extent, but also belief that, we'd spent so much time and money and effort and faith in the Basel II standard, and yet the financial crisis happened. So what's the main piece that was missing in the Basel II standard that should now be reviewed so that the risk of something like 2008 happening all over again is dramatically reduced? And then over the next couple of years, even though this is something that was in the works, but just like in 1996, the failure of long-term capital, in 1987, the crash on Black Monday drove how things change with respect to market risk and operational risk within the Basel I framework. In the Basel II framework, there was work done, had already been done and discussed, but there was a fresh push to review the standard so that the risk factors that led to the collapse of the financial system in 2008 could be addressed, and would certainly provide an early warning system for a regulator to act when something like this happened. So within the standard, we now call these, now there are different ways. These are known in some circles, these are called the Basel III requirements. In other circles, they simply call the liquidity adjustments to the Basel II standards. There you go. So what were the two primary additional factors? In addition to minimum capital requirements, banks were now expected to review and create what are now called minimum liquidity risk standards, and this has two primary pieces. The first obviously focuses on liquidity, which is a short-term focus, and this short-term focus is about 30 days. And the idea is, if the time comes, how much liquidity can you generate on short notice, and how does this liquidity compare with your liquidity needs if there was a run or if there was a liquidity crunch in your market? This is one piece. The second piece dealt with sources of funding. So one of the biggest challenges that both Lehman and Bear faced was then when the crisis actually came to their door, a number of their lines dried up. And the idea behind the net stable funding ratio was to assess the sources of funding that would remain available and compare these sources of funding to the uses of the same funding when the run happens. So the idea is, when a crisis occurs, there is bad news. This bad news leads to some pressure in the press. This pressure in the press leads to a slight curtailment of lines and deposits, sometimes even additional margin calls, sometimes even If you have a callable deposit, a drying up of that specific line, and that sort of just feeds the cycle. So bad news leads to press coverage, leads to um, an increase in margin requirements, a call for margin deposit, a withdrawal of deposits, which then simply makes things worse and leads to more leads to more bad news. So this cycle just keeps on going tighter and tighter and tighter till the bank actually fails. The idea behind the liquidity coverage ratio and net stable funding ratio was to ensure that the board, as well as the regulator, as well as the market, really understood that there are two primary areas when it comes to liquidity risk. The first is your ability to generate liquidity. The second is the usage or consumption of that liquidity on the liability side. And rather than looking at one dimension in isolation, the liquidity standard, basically, if you look at both, it's a ratio, liquidity coverage ratio, net stable funding ratio. Rather than looking at one dimension on primarily the asset side, the focus was to balance that point of view by looking at both the asset side and the liability front. And together, using this combined framework to create a mechanism for banks to look at their liquidity risk. Now, in addition to the ratios, the framework also introduced a number of monitoring tools that banks and regulators could use to review where you stood. So the first obviously was contractual maturity mismatch. And what this basically meant was that if you have a 5-year loan, is it funded by a 1-year deposit? If you have a 10-year bond in your investment and treasury portfolio, is it funded by a 3-month deposit? And let's use this to calculate what would happen if some of your short-term lines dried up and the markets tightened. The second was concentration of funding. So with respect to a given counterparty, or with respect to a collection of counterparties, is your funding risk associated and linked with a given name? Excuse me. And within that given name, are you exposed to significant liquidity exposure if that given name either goes under or does not renew or refuses to renew that line? The third piece was in terms of assets, especially those assets that are not pledged or occupied as collateral against any other additional line or funding sources that you put aside. So in terms of the amount of assets that you have that you could quickly convert into cash without any restrictions, without violating any covenants, without getting into trouble with your primary sources of funding. Then there was a fourth category that looked at, let's not look at just USD risk. If you're an international bank, there's a good chance that you have exposure in a range of multiple foreign currencies. So let's look at your liquidity profile. Let's look at your liquidity coverage ratio by each major currency that you work and operate with. And finally, the last and final piece was that generally when a crisis happens, generally when things start to fall, somehow, and there is many ways to debate this, somehow the market is always the first to find out. The market is always the first to find out before the regulators, the first to find out before the rating agencies. It's it's certainly the first to find out before the creditors and the shareholders. So the idea was, let's identify a range of market tools which are basically prices, which are basically your credit spread, which is basically your credit default spread, your credit default swap spread. So there are a number of sources, especially for large institutions, especially for institutions in both North American and Western European markets, where there is enough information available in the market that you can use to evaluate if something is happening that has not as yet come out completely in the public domain. So if I take a step back, essentially what we're saying is that you now had two coverage ratios, liquidity coverage and net stable funding, and side by side with these two ratios you had 5 additional tools that you could use to monitor liquidity. So combined with the ICAAP standard, the internal capital adequacy assessment standard, these additional liquidity adjustments basically filled up a big hole that existed on the liquidity risk side. And both with ICAAP as well as the Basel II liquidity adjustments, the focus was that rather than looking at the asset side, which is what we did when we did MCR, rather than looking at just the asset side, it is important for a bank to look at both the asset and the liability side. It's important for the bank to look at a range of different tools and ratios that integrate the interaction between assets and liabilities and the impact of this interaction on our capital, on our surplus, and on our equity. I think that's the fundamental lesson that came out of both ICAAP and the liquidity adjustment process. Uh, that I think that's the fundamental lesson that came out of both ICAAP as well as the liquidity adjustments. So if you now take or think about this for a second, in essence what we've done is that from 1930, which is where we started, so let's go back to 1930. In 1930 we said that higher rates on deposits are bad. By the time we came to 1980, this model was broken, and we said that look, you need to have an alternate standard other than a restriction on rates, and that within that alternate standard we said that our primary focus needs to be, or the primary principle that needs to be, is that if bank invest in risky assets, then they should hold capital in accordance with that investment. So for each category, so if I had a loan to a government entity, if I had a loan to a private or a public sector enterprise or a PSE, if I'd lent money to consumers on credit cards, if I had a portfolio of mortgage loans, I had a portfolio of auto loans, if I had a portfolio of commercial credit. So if I had this entire list, for each of these lists I said that this list has a risk weight. So if I lend to a government, traditionally, conventionally, if that government is in the market that I operate in, there's a good chance that this government's power to repay its obligation is completely guaranteed by its ability to print currency, right? So I should be able to get my principal back on a relative real basis. If that's worth what I put in is a separate story, but in terms of my notional exposure, there's very little chance that I would lose money. And in the standard that we came up, which we first called Basel I and Basel II, basically said that each risk asset has a risk weight that starts with 0 for treasury paper, for government bond, for government debt, goes to maybe anywhere between 0 to 20% for a PSC or a government entity. And then if I am dealing with corporate customers, depending on the rating of those customers, this weight can go from 20% all the way up to 150%. And the fact that I have a credit card portfolio, that I have a mortgage pool, that I have an auto pool, because I have large numbers, because there is some diversification in effect, then we should be able to give a little benefit, at least from a risk weight point of view, to these calculations. Right? So this was a Basel 1 and Basel 2 standard, and then we said that if you have X amount of risk-weighted assets, which is the sum of everything that you have here. So you take this amount and calculate your overall risk-weighted assets. Use the amount of capital you have available. Use the amount of capital you have available by comparing it with your risk-weighted assets to find out what your final capital adequacy number looks like. So for example, if I had $10 billion in capital and $200 billion in risk-weighted assets as defined by this process here, then my capital adequacy ratio was simply the amount of capital I carried divided by the risk-weighted assets that had come out from my Basel 1 and Basel 2 calculation, which basically meant that in this specific case, in this specific example, the number was about 5%. If the same 10 billion was linked to a balance sheet that was worth 100 billion, then this adequacy ratio jumped to about 10%. So between 1980 and 2003, there the Basel 1 and the Basel 2 standard actually went through a list of changes. We started off with credit in Basel 1, then we added market risk in 1996. There was a fair bit of work done on the op risk standard between 96 and 2003, and we finally came up with the advanced measurement approach, or as well as a simpler basic indicator approach on the op risk side, followed by more information, more disclosure on how the ICAAP process would be implemented, followed by the liquidity adjustments. I think the final document came out in 2010, 2011, but it was driven by everything that happened in 2008. So effectively what you were saying was that if this is the total amount of capital available through a bank, or at a bank, or for a bank, then you had individual pieces of risk-weighted assets for market risk, for op risk, for credit risk, and at later stages for all the other additional risk factors that came together. The challenge and the primary issue that we faced was that if this is the distribution of results of where I would be in terms of demands on my capital, this distribution is a very separate distribution for credit, for market, for op, for liquidity, and for ALM. And the biggest challenge was agreeing or determining the right approach of integrating these risks in one number. And when you talk about integration, your primary issue is how are these risks correlated? So how does this work with respect to rho AB or sigma AB, which is covariance? That's the challenge. Now, while a number of assumptions were made with respect to how correlations would work, when you look at the challenge that correlations present to both to regulators, to risk managers, and to board of directors and shareholders, is that correlations tend to break down. When we say they tend to break down, what we mean is that if you look at, let's say, if you look at oil as an example, right? Now, oil is not just crude oil. You can't just say I want crude oil. There are actually specific blends. So there is WTI, which is West Texas Intermediate. There is Brent, which is the European benchmark. There is Aramco, which is the Saudi production. There is Dubai, Oman, which is Abu Dhabi. and so on and so forth. So there are 1, 2, 3, 4 blends that, let's say, we look at in our specific example. You would assume that since all of this is crude oil, and because it's all linked to how demand works across the world, and how does that demand work with supply from all of these suppliers, that the prices across WTI, Brent, Aramco, Dubai Iman would be correlated. And you'd have very high level of correlation. But if you actually look through all of these uh, 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 all of these blends, you'll find that the price correlation across these is not stable. There are instances where it's high, then it suddenly drops, then it goes up, then it stays at a certain level, then it comes down, then it goes up, then it comes down. So it's all over the place. And when we say that correlations break down, this is exactly what we mean. If your model assumes that the correlation between market credit and op risk is very high, it'll produce or require or allocate capital in a certain fashion. But if the day after you do this calculation, correlations break down and fall all the way down, you have an issue. Now, the question is, when correlations break down, how long will they stay down? When will they come up? When they come up, how will we find out? The challenge is that all of this is post fact. The history that you're looking at is post fact. By definition, it's post fact, which means that you can't actually have a stable model for correlation, which then goes back to the original calculation that we've done earlier on the previous slide here, right? This calculation, this analysis, this assumption is basically driven by a model that makes certain assumptions about the level of correlation and interaction between all the risk categories and risk types that we've seen so far. So there is a fair bit of literature out there on what is a perfect stress test. By now, you should be fairly comfortable with respect to what is the concept of stress testing, should have some understanding of the amount of capital that is required, or a framework around managing, tracking, and calculating capital. You have some idea of how this works for market risk, some idea of how this works for credit, some idea of how this works for ALM and liquidity, and some idea of how all of this comes together on the capital adequacy framework side. When it comes to stress testing, you actually have two separate point of views. The first point of view is a regulatory point of view. This regulatory point of view is linked to minimum capital requirements. Your banking license is linked to your ability to satisfy the regulator with respect to the margin of safety you represent, that you provide for your depositors' interest. That's one piece. But the second piece is an economic capital piece. It's an internal capital piece. Now, while this piece or pieces of analysis done with respect to this specific area may make it to the regulator, your primary obligation on this side is to do this analysis for your shareholders, for your board members, and keep them in the loop with what's happening across this entire domain. And within this, I think the best possible stress test, based on the framework that we've looked at, that we've worked with, fall in two specific categories. The first is, let's look at history. Let's look at the darkest period of history in our market. Let's apply this and see what happens. So this is one. This is one approach. This is the most common. This is the basic approach that we've all used, where we basically look at a range of tools that give us some indication of how to find out what's the worst that can happen. The second is look at correlations. And more importantly, look at a breakdown in correlation that can break the bank. So rather than saying I have this amount of capital and here's the worst possible case that can happen, and based on that worst possible case, here's uh, 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 the amount of adequacy I'd have, do what we call reverse stress testing. So find out what level of shock here or here is required to completely wipe out your capital base. So that's 2. Third is when you do this analysis with respect to what's the level of capital or amount of capital, or sorry, what's the shock that's required to wipe out your current available capital, you can also extend this by calculating what we call probability of shortfall. So I have history that gives me my worst possible move. I have a level of capital that's available. I can use this capital to find out what is the range of shocks that can completely wipe out and eliminate this capital, and then I can simply calculate the likelihood and the probability of this shock occurring and coming along, and I call this the probability shortfall. In the insurance industry, we call this the probability of ruin. The only challenge here is that when you calculate this probability shortfall, what is the underlying distribution that you use? So the final tweak and the final twist to our stress test is you can use the normal distribution as your base case, but it's also useful and important to look at least a handful of distributions that have what we call fat tails, and assess the impact on your capital value, on your capital adequacy threshold, on your probability shortfall when you switch this distribution. Finally, as an analyst, I've always found that it's very easy to fall in love with your numbers and with your models, and when you do this analysis, sometimes the model becomes much more important than reality. If that happens, especially with respect to the stress testing model that you just looked at, and if a board member asks you about your level of confidence in the accuracy of your model, just remember a very important qualification that I picked up a long time ago, and that important qualification is all models are wrong, because by definition they are models. They are imperfect production, imperfect representation of reality. All models wrong, but with apologies to George Orwell and the Animal Farm, some models are more useful than others. On this happy note, I hope you've enjoyed our sessions on stress testing, ALM, capital adequacy, and the stress testing framework. Thank you very much for your time. This is Jawad Ahmed Fareed signing off for Learning Corporate Finance.